Let's jump right in. Today, we're unpacking the exact mechanics of leveraged buyouts. If you've ever looked at those massive corporate acquisitions and kind of wondered how the math actually works behind the scenes, well, you're in the right place. So let's dive into this explainer. Here's the hook. How do you buy a massive multi-million or even multi-billion-dollar company using mostly someone else's money? I mean, it sounds like a magic trick, doesn't it? But this is exactly the purchasing power wielded by private equity firms every single day. They pull off these colossal acquisitions, and they do it without tying up all of their own capital. The big question is, how?
Section 1. The billion-dollar question. Unlocking corporate finance.
Okay, so here's the formal definition. A leveraged buyout, or LBO, is a transaction where a private equity firm, which we often call the financial sponsor, acquires a company using mostly debt, and their intent? To improve operations, pay down that debt, and eventually sell it for a profit. I wanted to establish this strict technical baseline right off the bat. Basically, they borrow money, buy the company, fix it up, pay off the loan using the company's own cash, and then sell it. If that still sounds a little abstract, don't worry at all. We're going to build this into something incredibly familiar.
Section 2. Flipping houses for corporations. The everyday metaphor.
The corporate world actually mirrors real estate pretty perfectly. Think about flipping a house. You don't pay all cash, right? You put down a down payment and you get a mortgage for the rest. Then you remodel the kitchen, maybe update the bathrooms to increase the value, and finally you sell it. Well, in an LBO, a private equity firm does the exact same thing. The down payment is the sponsor equity. The mortgage is the debt financing. The remodel, that's making operational improvements, like cutting costs or boosting sales. And selling the house is the exit. It's literally just house flipping, but on $1 billion corporate scale.
And that brings us to a really crucial point, deleveraging. Think about your house again for a second. Every single month you pay your mortgage, you owe the bank a little less, right? And when you finally sell the house, you get to keep whatever cash is left over after paying off that remaining balance. By paying down the debt or deleveraging, you're actively increasing your share of the final pie. In an LBO, the private equity firm uses the acquired company's own cash flow to pay down the corporate debt over a few years. So when they finally sell, that massive debt reduction drives absolutely massive returns for the financial sponsor. It's brilliant.
Section 3. The magic of debt. Why use borrowed money?
Now, you might be wondering, if private equity firms have billions of dollars in their funds, why on earth do they borrow so much? Well, a typical modern LBO capital structure looks a bit like this, about 60% debt and 40% sponsor equity. Now, historically, like back in the wild days of the 1980s, this used to be an extreme 80% debt and 20% equity. Yeah, seriously. It's come down to 60-40 because of the inherent risks of just carrying too much debt. But hey, 60% is still a massive chunk of borrowed money, and they intentionally choose this structure for one very specific reason. And here is that reason. A fundamental rule of finance straight from our source material. Debt has a lower cost of capital than equity. This is the secret sauce, guys. Borrowing money is inherently cheaper than using your own cash or going out and raising money from new shareholders. By using cheaper borrowed money, private equity firms can essentially amplify their own returns. It makes it significantly easier for them to hit their high return thresholds because they're often aiming for like 15 to 25% internal rates of return, all because they're risking less of their own capital up front. But wait, there's a bonus here, and it's a huge one. It's called the tax shield. To put that in plain English, a tax shield means that the interest payments a company makes on its debt can actually be deducted from its taxes. Wall Street is essentially getting a massive tax discount just for carrying debt. And this provides an incredible additional incentive to use high leverage, simply because those tax savings leave more cash in the business to, you guessed it, pay down the debt even faster. Section 4. Finding the perfect target. What makes a company flippable? As you can imagine, not every company is a good candidate for an LBO. The ultimate target profile has a few really strict requirements. First and foremost, strong free cash flow. They absolutely must have cash coming in the door steadily to pay off that massive debt burden we just talked about. Second, recurring revenue. They want long-term contracts or subscriptions just so they know the money is dependable. Third, low capex, or capital expenditures. They really don't want a business that constantly needs to buy expensive new factories or equipment, because that drains the cash needed to service the debt. And finally, mission-critical products.
They want to buy a business that sells something its customers simply cannot survive without. That makes the revenue highly resilient, even if the economy takes a downturn.
But make no mistake, this entire strategy is a total tightrope walk. A high debt load equals a much lower margin of error. When you owe the bank huge fixed payments every single month, there's literally zero room for operational slip-ups. It forces the management team to be incredibly disciplined with costs and highly conservative with their spending. Just one bad quarter can put the entire company at risk of bankruptcy if they can't make those interest payments. It is a very high-stakes environment.
Section 5. The grand exit, cashing in the chips. So remember, private equity funds do not hold onto these companies forever. They typically operate on a really strict 5 to 7 year holding window. So how do they actually cash out? Well, there are 3 primary exit paths. Step 1 is a sale to a strategic buyer. This is usually the best case scenario, mainly because a competitor or a larger company in the same industry will often pay a premium price for synergies, which is just a fancy way of saying they can combine operations to save money. Step 2 is a secondary buyout. That's where they simply sell the company to another private equity firm. And step 3 is an initial public offering, or IPO, where they take the company public and sell shares on the stock market. Now, I want to give a quick warning on how they calculate their success at the exit. The risk of relying on multiple expansion. This essentially means hoping you can just sell the company later for a higher valuation multiple in the market than what you paid for it. Our sources are super clear on this. This is considered a really risky gamble. The market is completely unpredictable. A smart private equity firm generates their profit through actual debt paydown and growing the company's core earnings, rather than just crossing their fingers and hoping the market is feeling generous in 5 years. Section 6. Conclusion. The risk and reward tightrope. So we've journeyed from the basic definition of an LBO through the house flipping analogy. We've explored the sheer magic of tax shields and debt and looked at exactly how these firms pick their targets and eventually cash out. It really brings up a fascinating question. Is this high-wire act of highly leveraged companies a necessary tool for maximum financial efficiency? Does it force management to be sharper and leaner? Or is it kind of just a dangerous game of corporate roulette that puts thousands of jobs and companies at risk, all for the sake of financial engineering? It's a huge debate, and one that continues to shape our global economy every day. Definitely something to think about the next time you read about a multi-billion-dollar buyout in the news. Thanks so much for joining me on this explainer, and I'll see you next time.